Okay, good afternoon, everyone. Today's February 4th, 2022. This is the weekly take on the market. No surprise, I'm the host, Scott St. Clair. I am the manager of the Premium Product Group here at Investors Business Daily. Here is the disclaimer. Take a moment to look this over. We are not licensed at IBD, can't make buy, sell, hold recommendations. We are in the research education business. So hopefully you guys are, and most of you are, doing this on your own. Okay, we'll talk about the markets. We'll do the industry groups fairly quickly. Nothing's really changed. It's all the same groups. Oil and gas is leading the pack. And then we will look at a couple of stocks that are setting up. There are a few, but it's slim pickings, that's for sure. And then the quote of the week. A couple of things I saw this week I thought were really interesting. I don't know if I've ever shared this, but I have seen this chart numerous times about, the markets. If you bought the open each day and sold the close since like 1995, you're barely, even, you're break even. If you bought the close and sold the open, in other words, you had all the risk overnight, you're up over tenfold. So you have to take risk to make money. You get paid to take risk. It's no fun when they gap down or if you hold into earnings and they gap down, but that's part of it. And all of the risk is, there's just no free lunches. So day trading is, I don't know anyone that's day trading anymore. It's dead. It's too hard, right? If all the volatility is sucked out, when you're not trading. So thought this was very interesting, and I've seen this before, and you would think, up sixfold, up eightfold that it would end, but it's just pushing new highs. This is Facebook, Metaverse, the analyst estimates, how it started and how it's going, right? Especially after the earnings report. I guess there were 64 ratings on Facebook. Only 2 had a sell rating. It's very hard to have a sell rating on a stock like Facebook. Everyone else was buy, outperform. There were 9 holds, which is kind of in between, but you can see all of the buy, outperform, overweight. It's just a crowded trade. It's one thing Bill talks about, like, overowned. There is no magic number for overowned, but it's when they get overowned, there's problems. And when I see Facebook down 20%, all I could think about was who's going to step in here and be a buyer of Facebook. Yet there are plenty of guys and gals that want out of Facebook because it's been a core position. I think Melvin Capital allegedly, that's the fund that got hurt in the whole GameStop short squeeze. He had a huge position in Facebook. So, and it's, littered through every ETF, through every mutual fund. But they're all outperform, and then when it gets cut, it's underperform, cut the price target, etc. So the main thing is this is partly why, or mostly why, really, we just don't put a lot of weight, if any weight, on analyst estimates, analyst price targets, analyst recommendations. It's really, really difficult, and they also. There is that investment banking thing. So I know there's supposed to be a Chinese wall, and I've never worked at an investment bank. So I'm no expert on it, but it's got to be really difficult to be at XYZ bank and have a sell rating on Facebook. It's kind of frowned upon. Speaking of hedge funds, they got routed in January. No surprise. January was really tough. I think before the 2 last trading days of January, we'll pull up the chart. At that point, I think the S&P was down 9% before the 2 last trading days. which would have been the worst January ever in S&P history. I think it rallied 4% to finish down 5 or something, which made it the second worst January in history. But it's very difficult. Whale Rock, I don't know who they are. They lost 15% on the month, following a 9% loss last year. Tiger Global, one of the great names in hedge funds, lost almost 15%. Melvin Capital, who I talked about, Light Street, both lost 15% after double-digit losses last year. It's a bloodbath out there for these guys. And that's partly why I think the market is having a hard time getting a bid, is there's a lot of forced selling, or whether it's redemptions, fear of redemptions, and maybe there's a problem. A lot of times when the market can't go up, there's a problem that we don't know about. Somebody, that's loaded up, like Long-Term Capital story. If you've never read the story of Long-Term Capital, the Lowenstein book is great. I have too many books. I can't find it. I can't remember the title, but I do know the author is Lowenstein. I should have thought of that before, but I don't prepare, so it just came to me. But I think his name's Roger Lowenstein. It's a great read if you like financial history. Anyways, all right, so let's open up the charts. Here is a chart of the NASDAQ, and we'll talk. Oh, this is why I want to talk about the new RS line too, for sure, or the options. So I'm going to skip the industry groups today, or 60 seconds tops. So, I know we had a follow through day. Was it here? Was that the follow through day, everyone? Shows you how much I'm paying attention. So there's a lot of controversy about the follow through day. It is what it is. It doesn't work every time. We're not telling you that it works every time. We're not telling you to rush out and be fully invested. What a bunch of gobbledygook I see on Twitter sometimes about that. It's just reading the tea leaves of the index with the idea that we realize it could fail. It fails probably a third of the time, I think, when they tested it. But it's been a number of years since they did that. Maybe it fails a little bit more now. But it's an asymmetric trade, right? If it works big. If it doesn't, we lose small. That's the bottom line with it. And you're not rushing out to get fully invested. If you're in cash, maybe you buy one stock at a 5 or a 10% position and then just see what happens. One of the problems with this fall through day, and we'll be first to admit it, is there's nothing to buy, at least growth wise. All of the setups are in commodities, energy, etc. So maybe you buy that, but there isn't, at least I couldn't find, kind of a go-to name that's coming out of a sound base. Maybe you rush out and buy Apple or Google or something, but that's not really the right setup. So I'm skeptical this is going to work, but I'm almost always skeptical on follow through days. So I'm going to be open-minded and flexible to what could happen. My gut instinct is that we take out these lows, and that would negate the follow through day, and we'll start all over. But again, I'm not gonna put my flag in the ground and risk all or none bet that happens. If it starts to go up, if it gets legs, then I'll go with it. But there isn't a whole lot to buy, and so I'm very, very lightly invested, and even have some shorts to offset that. My net exposure is probably zilch. This is the NASDAQ. Let's go to the S&P. So holding up much better, right? It's above the 200-day, whereas the NASDAQ well below the 200-day. What percentage is that below the 200-day? 4.3%. The NASDAQ is just really, really heavy, really, really waterlogged. It's loaded up with all the high growth names, and those stocks can go down a lot because they're all trading, price for perfection sometimes. I'll talk about that right now, why we don't use like PE ratios. Two things with this. I was reading about Amos Hofstadter. He's the founder of Commodities Corp. If you've never heard of Commodities Corp, that's the place that seeded Paul Tudor Jones, Michael Marcus, and Market Wizards. Bruce Kovner worked there. A lot of people with tremendous track records worked there, and Amos Hofstadter was like the Bill O'Neill of Commodities Corp. Unfortunately, he passed away in a car accident fairly young. So he never wrote a book, or there's not a lot on it, but there is, some information on the web. But one guy wrote that he used to 30 days was kind of his number. If a market couldn't make a new high within 30 days, that would bother him. And I went back and looked, and this was the only time period where it was more than 30 days. But here, just inside 30 days, just inside 30 days, just inside 30 days. So I thought that was interesting. And really, it's funny, where day 30 of this, where the market made a new high and started to come off, day 30 is right there. That's amazing. That's day 30 where market has not made a new high. And you also had a divergence in there where the S&P made a new high. This is 1227. And on 1227, that's this blue day right there. The NASDAQ cannot make a new high. Can't even take out that previous high. So it's easy in hindsight, but those divergences are a clear signal that something is starting to be really wrong. And the market's rolled over. So I know that IBD has this in an uptrend or confirmed uptrend. I would be cautious. I would be, playing it close to the vest. But it's up to you as far as new positions. If you're gonna have a Tesla, an Nvidia, a Google, a Facebook, if you're gonna hold something for a really long time, Square, PayPal, could go on, and capture a 5, 6, 7, 8-fold move, you're going to have to sit through a bear market. We've been spoiled for the last number of years. The bear markets, the corrections have been short, swift. They've been nasty. The COVID one was nasty. The 2018 Powell pivot one was nasty, but they were short and they came back really quick. I don't know. I'm not going to predict, but from a probability standpoint, this one seems like coming back quick is unlikely. There's a lot of damage. The analogy is, if Scott O'Neill would say, if you're a runner, he had a great analogy. I'm going to steal it. And I've used this on IBD Live, but if you're a long distance runner and you twist your ankle, you might be out for 3 days, a week, depending on how bad you twisted it, maybe 2 weeks. If you tore your Achilles tendon, you're going to be out 6-9 months. You're going to be out a long time, something like that, because it's a much worse injury. I have torn my Achilles tendon. I know what it's like. It's a long rehab. It's not like twisting an ankle. It's a lot of work to that. Steps too. There's steps to getting better. Surgery, boot, cast, walking, swimming, running, lifting weights, etc. Right? You build on all of that over a number of months. And this market has torn its Achilles tendon, the way I look at it. And there's a lot of bad breaks. Most of the stocks in the NASDAQ are down 50% or more from their highs. The indexes have been masked, are holding up because of Apple and before Facebook, but Google, Apple, are holding up really well. And one thing about the S&P, I don't know the weightings. I think energy is a very low weighting now because the weightings tend to be cyclical. But if energy is a 10% weighting or let's start with growth stocks, they're a 10% weighting and they go down 20%. But energy is a 10% weighting and it goes up 20%. What does the S&P do? Right? It just goes sideways. It goes straight, right? There's no damage, all other stocks being equal. And I think that's why the S&P is held up so much better, because it has exposure in those areas that the NASDAQ It does not. Let's look at the Russell IWM. What are we down? 20%, something like that. Let me go to the weekly to do the math. It's down 18, but at one point it probably was down 20. Doesn't look very good. And then last but not least, emerging markets down 16. You know, not getting hit really hard, but there's no umph there. There's no, upside. But maybe there could be if the US market started to not necessarily get legs, but just got a little bit healthier. All right, let's go to the industry groups, and then I will do the new feature. Industry group rank. I haven't looked at it in a few days. I'm going to guess it's just littered with energy. Yeah. Oil, energy, oil, media periodicals. I don't know what's holding that up, but I'm not really that interested. Oil, chemicals, agriculture. I own a stock in that group, CF. I'm pretty certain that's the group CF is in. Oil, transportation, shipping, oil. You get it. That's the area that's holding up best. Stocks to watch. CF, chemicals, agriculture, that is the group it's in. It's holding up really well. It lost the pattern rec. Excuse me, sorry about that. It used to have a ascending base here, and for whatever reason, it kind of lost the ascending base. I don't know if it's the something about it, the pattern rec didn't like. Still looks like an ascending base to me with a pivot of 74, 77. Now it's not really running away. You have earnings in a couple of weeks, but it sure is holding up better than most with the market. Relative strength 98 and the RS line heading in the right direction. CLR, Continental Resources, broke out of this cup with handle. Relative strength 99. The ducks were quacking a little bit today. I actually took some off because the oil is, I don't know, sometimes I start to see that, more and more people are talking about it, and that makes me nervous that a shakeout is coming. So this is the best group, but I feel like it's been the best group for a while. Possibly shakeout coming. SM tried to break out and couldn't. So I know what I want to talk about. Well, let's look at Facebook. And, I have a friend, I assume he's still in Facebook. He's been in it forever. And so, to have a big winner, when I say forever, I feel like he's, he bought it somewhere in here. To have a big winner, you've got to ignore a bunch of sell signals along the way. So for me, for somebody who's more active trader, for most people probably, Facebook had so many sell signals that hopefully you didn't get hurt in it. Unless you kept it through the earnings, is because you had a big cushion in it, but it just was just a laggard for a long time. Zoom is the one I want to talk about. Earnings are so important to moving a stock, and the PE just does not matter. So when Zoom was doing this, the PE was triple digits, like really high triple digits, 300, 400, 500, if I recall correctly. And the earnings were astounding. Look at these earnings all through that period, 900, 900, 700, 500. Look at the revenues, 300, just incredible numbers. And the PE was super high. So everyone who's looking at PE would say, well, it's too high. I can't buy that stock. The PE is too high. And it was not an easy trade. Honestly, I didn't do that great in Zoom considering where it went because of the volatility. It's pretty choppy, but from 100 to 500 with the PE super high. And then the earnings start to slow down and the price comes in, and now you've got a PE that's more reasonable. It's 28. It's barely higher, 30% higher than the S&P. That's what that 1.3 times means. How much higher or lower, if it was 0.9, versus the PE of the overall market. So it's only 1.3 times the PE of the S&P. And I do see some people talking about buying Zoom, and they've bought Zoom and they buy Zoom and it goes lower and it goes lower and it goes lower. And they talk about the PE and the PE and the PE, and PE doesn't mean anything because the earnings are slowing. And so the PE is great on the way down. So the lesson is the PE, it just does not work. It's not a good indicator for buys and sells, timing them wise. Big earnings and sales, and that's the key. And the market will anticipate that slowdown. What happened when Zoom announced earnings up 48% was right there. But look right here, earnings were up 999%, but the stock had already topped. Earnings right here were up 700%, but the stock had already topped, right? So the institutions are buying in anticipation of those earnings. Any other stocks that I want to talk about? I can't remember if there was one other as far as stocks to watch. No. Okay. The RS line. So you can now customize the RS line with the wrench in the upper right corner. There's a video on our website under video tutorials as well. Click on relative strength. The default is the S&P 500. That's what that blue line is. Let me turn off the other one. Apply changes. So this is the normal one you'll see. You can now add a moving average to that relative strength line. So it's just going to smooth out the relative strength line. So a lot like the price of Apple is above the moving average, the relative strength line of Apple is above its moving average. Which moving average do I have there? Well, let's go. I've got a 50-day. Play with it. I don't have the answer as far as what's the right moving average or anything like that. Honestly, I didn't even realize that having a moving average was something on a relative strength that you could have. This was Arusha's build. So I'm just getting used to it and trying to understand it. But, I used 50-day because that's what we have. You could put 21-day. You can put two of them on the or on the weekly. I've got the 10-week, which kind of matches the moving averages of the stock on the monthly moving average. So you can just add in moving averages if you want. If you want to remove them, you definitely just wipe them clean to do that. If you want to add a line, it says add a line, and your options are an index. So I could choose the NASDAQ, the NYSE, the S&P again. Well, I don't know why you'd want to do that, but if you prefer the second one to be S&P, I can choose the company's group. So it automatically knows the company's group. I don't have to input the symbol. Let's hit apply changes. And here's let's go to the weekly. You can kind of see them better because it's not as busy. But here's the moving average of Apple versus the telecom group. Now, a lot of times the stocks that we're in or looking at, they're leaders. So they'll have a higher weighting inside the industry group. Therefore, it's kind of the tail wagging the dog problem, right? They're going to just kind of be flat. So Tesla, I imagine, would be pretty flat. Yeah. So you keep that in mind when you choose the industry group. Something else that's maybe like KLAC or LRCX, you might be able to read a little bit more into the industry group one. Let's go back there. You've got symbol, which is kind of cool. I actually like this. NVIDIA, for example. Or I could put in FCNTX, right? Fidelity Contra. Maybe I ought to just put all my money in Fidelity Contra and just play golf in the afternoons and not worry about the market. Well, let's see. If the stocks I'm buying, they should be outperforming Fidelity Contra. So I can overlay NVIDIA to the Fidelity Contra Fund, right? Or I could choose another stock. Let's go relative strength line. Why don't I just put all my money in NVIDIA? Well, probably was a good idea many moons ago. Well, NVIDIA versus NVIDIA is just going to be a flat line, right? But how about Apple versus NVIDIA? And there's when NVIDIA was outperforming, and then you can see around this point, it's very subtle, but now NVIDIA is underperforming or Apple is outperforming NVIDIA. Now, sometimes it's going to go off the chart like this because we just, due to scaling, we can't jam two relative strength lines down below here, especially the moving averages. So you can get a little busy. Keep that in mind, play around with it. But we just want to give you options. That's the main thing. If it's too noisy for you, great. Don't, just leave it be. I haven't decided honestly how I'm going to attack this, whether I'm just going to leave it be. I might just leave it be, but it's nice to have. Let's say I want to buy, I don't know, I want to buy a gold stock, TQR. Is that a gold? What's that one? Turquoise or is AGI a gold stock? All right. Here's AGI. Maybe I go in here and just change it to gold, right? Well, let's see. Is this mining stock acting better than GLD? You can sort of see it's almost the exact same thing. Really, just all the wiggles are almost the exact same thing. It's like, then why buy AGI? I might as well just buy gold if I want to buy gold. So there could be situations where it makes sense to change them. You just have to remember, what you changed it to, and go in here because there's no hover feature. That will be in the next edition, where you'll be able to hover over the line and it will tell you NVIDIA or FCNTX. That way I don't have to go in the wrench to see what I've done if I don't remember. All right. And then on the home page, under resources and video tutorials, right here is a video, probably 85% correlation with what I just told you. But I did the same kind of demo on IBD Live, so you can watch that right here if you'd like. Okay, let's go to the quote of the week. It's the same quote, almost, by two different people. And it's George Soros. He says, "I'm not predicting, I'm observing." And I was reading an old interview with Bill O'Neill, and somebody asked him about, it was old, it was like in the mid-90s or something. Somebody asked him about Japan and what's the yen going to do or something like that. How will that affect the U.S. trade deficit, how will that affect the stock market? And all Bill said was, "I don't predict," right? So we don't predict what the market's going to do. We're just observing what it's going to do and just take it day by day. Doesn't mean you're making changes day by day, but I just think, and you're welcome to try it. I'll tell you, my personal track record is very, very poor. It's almost unblemished, actually, on when I try to make some type of macro bet 2, 3, 4, 7 years out. Oh, I think XYZ is going to do this. It just doesn't work for me. I've never been able to make that work. So, but if I'm observing day by day, week by week, I find that I can handle that. I can change too if something changes. If I have some kind of 3-year time horizon where I think XYZ is going to be, and if something changes in 3 months, I've got a 2.5 year plus window of where I could just get really hurt because I'm not willing to change. I've got this 3-year window. So it's just too far out. So the best in the business, they're not predicting where things are going. They're reacting to what's happening and going with it. Okay, thank you guys. Here's our contact information. Reach us at marcusmith.com, 800-831-2525. Have a great weekend. We will see you next week. Thanks. Bye-bye.